Good evening, class, and welcome to our advanced taxation class for today. We are taking the topic capital gains tax. Capital gains tax is a topic that is, can I say, 90% frequent in your exam. And so there is a 9 to 10 chance of meeting this topic. So I would like you to pay close attention to this topic because passing this topic means having a big chunk of marks on your exams. Now, after joining me in this class, you will know how capital gains tax is administered. You will understand the nature and objectives of capital gains tax. Then you understand the principles of allowable and disallowable expenditure as applicable to capital gains tax. And you will know the chargeable gains that are exempt from capital gains tax. Then you will understand all the capital gains tax issues involved in acquisition and disposal of assets. Then you will be able to know the reliefs available in the capital gains tax and all that. So these are the things you stand to gain from this chapter. What is the nature of capital gains tax? In the usual tax computations, which is taxation of profit and loss of businesses, or profit or loss of disposal are usually excluded. So it means that if I am doing if I'm doing company income tax and I am looking at profits, and maybe I dispose of my assets and I get money from it. The money I get from that disposal is never included in your revenue. This is because you have disposed of assets. Assets are not your operations. Let me give an example. You are into buying and selling of rice in bags. So you buy rice in bags and sell them. This is your stock in trade. This is your regular business. Now you have your vehicle that you use as delivery van. You now dispose one of your delivery van, and the money you get is not revenue. Now, let's assuming that you sold it at a profit or at a gain. Now, because I will not use profit, because profit is the technical language used for revenue operations. If you have a surplus, and that's a technical word, surplus, then you will be said to have a gain. You will be said to have a gain. So when you are disposing of an asset, you either have a gain, not profit, or you have a surplus or deficit. So it is that gain that is being taxed here. It is these gains that are accounted for in capital gains tax. So disposal of assets are usually excluded by means of adjustment in the relevant accounting results. At the same time, balancing adjustment will be made in the capital allowance computation in respect of the difference between the proceeds of disposal and the tax written down as value, and that difference will either be balancing charge or balancing allowance. So you see here, if assets is being sold, it is not the proceeds from the assets that is looked at. It is not the gains from the asset that is being looked at. What is looked at here is the tax written down value of the assets versus what you have received now. Because your tax written down value represents what you will receive in the long run if you don't sell the assets. Your tax written down value represents what you should get now if we are to sell the assets at no profits or at no gain. Now, when you sell the asset at a gain, now the difference between the cash proceed and the tax written down value, we've learned that it's either going to be a balancing charge or a balancing allowance. Now, these do not concern capital gains tax, but we are trying to build something here. What we are trying to build here is that when you are doing your company income tax, disposal of assets do not figure. All right. Now, we say here that, let's go down here. In taxation law and practice, all transactions of capital nature are excluded from income tax. So this is the point I want to make here. This is the point I am making. In taxation law and practice, all transactions of capital nature are excluded from income tax. So, example of transaction in capital nature is right. Sorry about that. So in view of the fact that surplus is referred to as a capital receipt, sorry for that interruption. Some people were calling my line even when they know I'm in class. So sorry. So we say that here in taxation law and practice, all transactions of a capital nature are excluded from income tax. So you buy assets, the action of buying an asset or acquiring an asset is excluded. Only the wear and tear, which comes as a result of capital allowances are included. In view of the fact that the surplus referred to is a capital receipt, it cannot be included in gains or profit for income tax purposes. So when you buy an asset and you sold it for gain, you cannot include it for income tax purposes. So the government still have to tax that gain. And so they created a separate tax called capital gains tax. So this is just for items. The Capital Gains Tax Act 7 came after this, but before the Constitution. So it came into 68 assessment year. In addition to the necessity to charge capital gains tax, as illustrated above, sorry, the network has been a bit funny this night. Bear with me. All right, so let's go to where it's necessary. Administration of capital gains tax. Gains tax is placed under that in the hands of the Federal Inland Revenue Service. Now, the thing to note here is Federal Inland Revenue Service, FIRS, is charged with administering capital gains for companies, whereas the state internal revenue is charged with the responsibility of administering tax or capital gains tax on the capital gains of an individual. So that's of the Federal Capital Territory tax administrators are saddled with that of those in the FCT and also those that are non-resident. Now let's go to capital gains proper. What is a capital gain? A capital gain is the gain arising from the increase in the market value of assets, capital assets. So when a capital asset increase in value, it is said to have gains. You know, normally in your FRO or CRO, when you revalue assets and it is increased in value, you may say to have revaluation gains. That sort of thing is what is being applied here in capital gains tax. I am not saying that revaluation surplus is capital gains, no. These are two different things, but I'm using that to explain. So when an asset gains in value, it is said to have capital gain. Now, it is the difference between the consideration accruing and the sum excluded from the consideration. So what it means here is that the cost of or the value of the assets when it is being about to be sold, excluding every cost that are, that are part of making that asset in the right place and position to be sold. I'm going to explain that further to you. So it means now that if you have an asset and let's say you have a land that you bought for ₦1 million, example, and you decide to sell the land for 10 million naira. Now, the land has increased in value from 2 million to the 10 million that you are selling it. Now, let's say when you bought the land 2 million, it was swampy. You now decided to do some sand filling. You spent money in sand filling the land. That cost of sand filling the land is also going to be excluded from the 10 million. So it means that as you are selling that land for 10 million, you need to remove the money you spent in sand filling the land. Perhaps you build a fence on it. The amount you spend in erecting that fence also needs to be removed. So that's what we are saying here. Now, one guiding principle is to examine the purpose for which the asset is bought or sold. Where an asset is acquired or kept for use as an investment, proceeds on the disposal of such assets shall be treated as a capital receipt. When an asset is acquired for investment purposes, any gain is treated as a capital gain. On the other hand, where a fixed asset are kept and sold regularly for gains or profits, such assets shall be treated as normal income. I will give you an example. You bought a land or you bought a car for the purpose of investment. That's an investment. Now that land or car is an asset. It's an investment. When you sell it and you make a gain, it's capital gains. Now, when you buy an asset, let me use this example now so that you make sense now. You are a car dealer. You are a car dealer. You buy this car for buying and selling. You are a car dealer. Your stock in trade is car dealing. So now you are selling Toyota Corolla, any model. You buy and sell them as your stock in trade. This fixed asset that is fixed in nature, you buy and sell, is no longer fixed asset in your eyes or in your hands. They are seen as stock or inventory. And so any gain you get from selling these cars is profit and is treated as and taxed under the personal income tax or the company income tax, because this is your regular income. But if you have a particular car, even if it is Toyota Corolla, or let's say a limousine, or car, maybe any other car, but you are using it not as your inventory, but as an asset, like for delivery or for driving or for any other thing, not for the regular buying and selling, not for the regular trade. Now, when you sell that particular asset, though you are a car dealer and you sell that asset that you are not doing your regular trade on, that gain is treated as a capital gain. So that's it. All right, so let's go. CGT imposition. The tax is imposed on gains arising out of the ownership of a capital asset changing hands, either by exchange, transfer, or sale or gift. So it means that when an asset, not now, when I'm teaching this topic, I will be differentiating assets from inventory. So I'm talking about assets now. When an asset is changing hands, you are disposing it. When an inventory is changing hands, you are selling it. So I'm not talking about sell. I'm talking about changing hands by way of transfer, disposal. So I will change this sales here to disposal because technically it's used for inventory changing hands. Now, That is capital gains coming into play. The act as it is presently is silent on gains arising from the appreciation in value of an asset, which has not changed hands over time. So it means that if an asset, let's say a land, appreciates in value, though it has not been sold, it appreciates in value in your hands. The act does not state whether that increase in value represents capital gains to be taxed. Yes, that increase in value is a capital gain in your hand, but the act is silent on charging such increase or appreciation of assets in value in your hands. It is only when it has changed hands that we cannot talk about it. Okay, so capital gains tax is chargeable on the total amount of the chargeable gains arising after deducting allowable expense on the disposal of chargeable assets in the year of assessment. Now, coming to that example I was giving you about a man who buys a land that is swampy, he now decided to sandfill it. The amount spent in sandfilling that land is allowable. Somebody is asking the question. Okay, somebody's mute. Somebody's interrupting. So sorry. Okay. Going back to that example, when you buy a land, maybe in a riverine area, and you need to sandfill it, the amount is spent in sandfilling. Now, I will call it improvement costs. So the amount is spent improving the value of the asset, improving the assets is an allowable deduction. So you must deduct that before charging your capital gains. Now let's look at the year of assessment. A year of assessment in relation to capital gains tax means a year beginning from January 1 to December 33 in the same calendar year with effect from 1969. So it means that capital gains tax is charged on actual year basis. So when you're looking at capital gains tax, it is on actual year basis, not preceding year basis. So now you'll be seeing it now. What are some differences between company income tax and capital gains tax? Company income tax, preceding year basis. Capital gains tax, actual year basis. Company income tax, 12 months, any 12 months that is ending on the company's year end. Capital gains tax must be from January 1 to December 31st. Company income tax, the assets, capital gains, any disposal or acquisition of capital expenditure or items are not included. Capital gains tax, acquisition, disposal, the gains arising is what is being taxed. Now let's look at the allowable and the disallowable expenditure. Now look at the allowable deductions. Now, normally, I usually want to say there are 3 in my eyes, but let's look at this. Later I will bring them under these 3 umbrellas. Now, the first one is cost of acquisition or purchase price, including all costs incidental to purchase. So let's come to the land again. So you buy the land for 2 million. That is the asking price. You buy that land for 2 million. Then that is the purchase price. What are the other costs incidental to purchase? You may need to pay a valuer to value the land. You may need to pay conveyance fee, lawyer's fee, transfer fees. All of these are costs incidental to purchase. So normally, you are supposed to have included all these costs to the purchase price to get your cost of acquisition. So first thing here is I want to differentiate these two costs. The purchase price is the cost of acquisition. So I'm going to check it here, and here is this is the cost of acquisition. It's allowable. Then the other one is incidental of purchase. Now, the next one is improvement costs. Improvement costs that are wholly, reasonably, exclusively, and necessary. We usually call it REN. Wholly, reasonably, exclusively, and necessarily incurred. So, improvement cost. So now, the difference here is that your cost of acquisition is the asking price for the land. The other incidental cost is there. Improvement cost is that cost I said before of maybe sand filling the land because it's swampy and doing other things to make the land become habitable so that you can start maybe building on it. Then the next one is costs, wholly, reasonably, and necessarily, exclusively and necessarily incurred in establishing, preserving, or defending the owner's title. So, owner's title. Then the next one is incidental cost of disposal. So this is cost of purchase, cost of disposal is another incidental cost. Incidental cost. Now, what are the incidental costs of disposal? Now, for somebody who is disposing his assets, let's say it's a land or a house that he wants to dispose. He now put security men so that security people will be looking after the house to ward off thieves. Nobody is living there and you are paying them. Maybe there is a gardener who is taking care of the garden so that it will be looking nice. Cost of advertising this house for sale, either in online, print media. There is a caretaker who is also looking after the house. There is an agent who brings the buyer and he gets agency fees. Any cost you spent to ensure that that house is being disposed of is incidental cost of disposal. All right? These include fees, commissions, remuneration paid for professional services of surveyor, valuer, auctioneer, and all that. Cost of transfer or conveyance, advertisement cost to find a buyer or seller, cost reasonably incurred to make any valuation or apportionment required for the purpose of computing capital gains tax. So now, look at it now. You're about to sell, you have a duplex, and you want to sell one of them. Maybe it's a twin duplex. You want to sell the other one, and you call a valuer, and they value that portion. That cost for valuation, the cost that you incur to make that valuation is allowable. All right, what about the disallowable expenditure? Now, sums allowable as deduction in computing profit or gain or loss of trade for income tax purposes are disallowed. Now, it means that whatever you are doing for income tax purposes, you are allowing them for income tax purposes, automatically is disallowed for capital gains tax because they are different things. Income tax purposes is revenue in nature, and we don't always allow capital things to be allowed. When we are doing capital gains tax, we will not allow any revenue item to be allowable also. Then the next one here is insurance premium on the assets are not allowable. Okay, so that's it. So let's look at the rates. Now the rates, I don't know what's happening to my mouse. The rate is chargeable at 10%, arising from the disposal of assets. So for now, it is 10% arising from the sale of asset or disposal of an asset. I'll use the technical word here, disposal. All right. Computation of capital gains. How do we compute capital gains? Now, Section 3 of the CGT Act defines capital or chargeable assets as meaning all forms of property, whether it is situated in Nigeria or not. And they include options, debts, incorporeal property generally. Now, it could also include any currency other than the Naira. That's the capital gains. Any form of, that's chargeable assets rather, any form of property created by the person disposing of it. Then stock of and shares of every description. Then we look at in respect of assets outside Nigeria and disposed by non-resident individual or trustee or settlement. So a company whose activities are managed and controlled outside Nigeria. So we are building backgrounds. We'll come to the calculation proper. Now look at exemptions from capital gains tax. Now, the capital gains that are exempted from capital gains tax are any gains that is accruable to an ecclesiastical or charitable or educational institution of a public character. So it means that if you are running a church and you are having capital gains, you're not doing business. So your gains is not chargeable to capital gains tax. If you are running a charitable organization, you are not liable. Now, educational institution of a public character. Now, the public character is a legal word there that is used to describe some institutions. So let's say, for example, the University of Lagos or University of Abuja, these are public schools, public private government schools. So they fall under institution, educational institution of a public character. But private schools, let's say Bangkok University, may not fall under it. Then the Institute of Chartered Accountants of Nigeria may fall under that. But tuition centers like FCA that are coming into existence for profit making may not fall under public character. So let's know that. You may want to read some of these things here. So let's go down to the business of the day. Let's go down to the meat of the day. Let's go to the meaning of disposal. Except as specifically exempted by the Act, there is a disposal of assets by a person where any capital sum is derived from a sale, lease, transfer, assignment, compulsory acquisition, or any other disposition of assets, notwithstanding that no asset is acquired by the person paying the capital sum, and in particular, where there is capital sum is derived by way of compensation for the loss of an office. Okay, then another one is where capital sum is received under a policy of insurance and the risk of any kind of damage or injury, or where the capital sum is received in return for forfeiture or surrender of rights or from refraining of exercising those rights. Where any capital sum is received as consideration for use or exploration of any asset. And so there is. So they are just giving you the meaning of what they mean by disposal. Let's go into here. Hire purchase transactions. Where a fixed asset is purchased under hire purchase, the cost for tax purposes is the cash price for that asset. Remember when we were doing capital gains tax and we were doing hire purchase for capital allowance. Sorry, when we were doing capital allowances and we did hire purchase. Remember we talked about cash price, talked about hire purchase, and the total purchase, the total payment, expected payments would be all your cash price plus your hire purchase. Now, for capital gains tax purposes, it's only the cash price of the assets that is considered. The hire purchase charges represent interest, and they are allowable under SITA, and so they are not allowable under CGT. Thus, for capital gains tax purposes, if all the installments have been paid before the date of disposal, we are going to be using the full cash price to be taken for the capital gains tax. However, if the installments have not been fully paid, now the cost of the asset at the time of disposal will be the cash portion, the capital portion of the installment paid to the date of disposal. Now let's see one example. So this is one scenario that capital gains tax might be tested. All right, so illustration 1, Union Company Limited purchased a chargeable asset on hire purchase. Still saying a question or a comment?
Yeah, sorry, please can you go back to the you were fast, like the higher purchase, you're quite very
When I will
fast.
treat a question now, I will re-emphasize what I said.
Okay.
When I'm treating this question now, you will see how I will going to restate that fact.
Okay, all right.
Union Company Limited purchase a chargeable asset on hire purchase. Now remember, we treated hire purchase on capital allowance. The same kind of treatment is what we are doing, but now we are challenging this for capital gains. Now the deposit paid for the purchase, which is the initial deposit, was 250. Let me clean it so that it will not distort the figure. 250. And the balance of the purchase price is to be paid in 36 monthly installments of 25,000 naira. So what we mean here is that this 25,000 naira contains both capital and interest. We are going to be looking at the capital parts. This 250,000 is a capital payment. This initial deposit is capital payment. We are going to extract from this 25,000 the capital element out of it and discard the interest element. And we are told that the cash price is 790. Now, what it means is that this is the cost of the assets. Normally, this is what we are supposed to be using. Now, if this person has paid all 36 installments, this is what we'll be using when we are looking for capital gains tax. But if he is not finished paying, then we will use a portion up to what he's going to be paid. Now look at it now. In A part, he has paid only 24 installments out of 36. So we are going to take the capital part of these 24 installments. But look at it now. In the second part, after full payment of all installments, I'm still seeing comments. Someone say, I can't see your screen. Who else can see my screen? Let me stop sharing for the sake of everyone and reshare. No doubt, everyone now can see my screen. Okay, so what we are saying now is we are required to calculate the capital gains due, assuming the assets were sold. So this is the amount sold. So we'll come now and do this question. Illustration what? 13.1. What's the name of the asset? Union Company Limited. Union Company Limited. Now, we are told to calculate the capital gains tax. Now, for which year? We are not told the year, but suffice it to know that it's actual year basis. So how will you know the year of assessment? Look at the year it was sold. The year it was sold is the year of the assessment. Now, what's the formula for capital gains tax? Look at the format. Cash proceed on disposal okay, I'll say net. I will tell you why I use net. Less cost of acquisition less all allowable deductions is capital gains. As capital gains, then capital gains tax at 10% of capital gains. So that's the basic formula for it. So what we are going to do now is the A part says the asset was sold for 1.25 million. So what we are going to do here is A, C, G, T. So we'll say cash proceed on disposal. What is the cash proceed on disposal? 1.25 million. 1,250,000. So this is your cash proceeds. So now let's say less cost of acquisition. I'm going to do workings on it. So there is no other allowable deductions given here. So we just rule our line here. So this would be our capital gains. So this will be our capital gains that are CGT at 10% of capital gains. Whatever we get to put it down here. So we will now go to our workings. Number one, costs of acquisition. So how do we get the cost of acquisition? You know, this is a hire purchase. So we need to know what our hire purchase price is. So we'll talk about the A part first. I'll say the first part is hire purchase per installment. So this is what we want to find first. So the first thing is initial deposits. Initial deposits. What is the initial deposit? Just a moment. Initial deposit here initial deposit was told to be 250,000 naira. It's a capital payment. So this is 250,000. Okay. Installments. Installments. We are told that the balance is to be paid out of 36 monthly installments of 25,000 each. So installment is 36 months times, let me use months so that we are revising it, we know it's months. 36 months times 25,000 per month. So what we do here is 25,000 times 36 months. That gives us 900,000. So that will give me 900,000. All right. Now, when you add these two, initial and all the monthly installments, so these are your expected payments. So that will give you 1,150,000. So these are your expected payments. These are all that you expect to pay. So this your expected payments contains capital and interest elements. So what you will do here is you less the cash price. The cash price is only capital assets that would have been the case if you are buying the assets immediately, 790,000. So you less 790,000, which is the cash price. So what do we do now? 900 plus 250,000. That gives me this, then less 790,000. That gives me 360. That's fine. 360,000 is your total higher purchase interest. Okay, this is a higher purchase interest. So you say HP interest by installment will be 360,000 divided by 36 installments. So that would be 10,000 naira. So that's what the first part you have calculated. The second part is capital payments. Capital payments per installment. Capital payments per installment. So you say amount paid per installment. So each time you are making your installment, you say the balance is paid is of the purchase price is to be paid in 36 monthly installment of 25,000 naira. So each time you make your installment, you are paying 25,000 naira every month, every installment. Now, less HP interest per installment. So this is the non-capital payments. This is HP interest. So you are lessening this 10,000. So it then means that 15,000 is the capital payment you are making per installment. So this is your capital payment per installment. So it means that for every 25,000 you pay, 15,000 naira goes for capital payments, whereas 10,000 naira goes to service your interest. We are not after the interest, we are after the capital payments. Now, the third thing now is to find your cost of acquisition to date. Okay, you are going to calculate your cost of acquisition to date. So which is the third one? cost of acquisition to date. So how do you do it? You'll go this way. Initial deposits, that's 250,000. We are told that capital payments to date is simply this 15,000 multiplied by how many installments it's made to date? 24 installments. So you multiply by 24 installments. So I'll go here, 15,000 multiplied by 24. That gives me 360. Now this figure might seem coincidental. Why am I getting 360? Well, it's fine. 360 is what we are getting. Just write it here. 360. So this is your capital payment. So when you add 360 plus 250, that gives you 610. 610,000. This is your cost of acquisition to date. So this is what we are going to use as our cost of acquisition. So you come up here and you put your, is this 600 we got? 610. So 610 is what we put here. 610 is our cost of acquisition. So we're going to less it from 1,250,000. That will give us 640. 640,000. And of course, 10% of that will give you 64,000. Now that's your capital gains tax when you are charging it on the 24 installments that you have made. Now, the second part of the question says, change the color. Second part of the question says, it was sold for 1.3 after full payment of all installments. So this is easy. We now say cash proceed on disposal 1,300,000. Now your costs. So if I do something like this, COA, I mean cost of acquisition. Cost of acquisition. Now you have said that after full payment of the installments have been made, your cost of acquisition here, after all acquisition has been made, will be the cash price. The cash price, which is 790,000. Now let's test it out if it is true. Cost of acquisition, I can say which is the cash price, 790,000. But for those of us who still want to test it out this way, we can say initial deposits as 250,000. Then capital installments. So you can say 15,000 multiplied by 36 months. So we say 15,000 times 36, that gives me 540. 540. When you add this, it gives me 790. Like we said. So you may not need to waste your time doing this when you see that the whole assets, the whole installments have been paid. But assuming it is after the payment of 35 installments, you know it's 36 installments, right? But if 35 has just been paid and you are selling it, you will not take the cash price. You will only take 15,000 times 36 months or 35 months, add to 250. Or somebody might decide to say a shortcut, 790 minus 15,000, because 15,000 is one monthly payment, and 36 months would have given you complete. 35 months will be 15,000 naira short. So these are just shortcuts. But for now, they said the installments have been fully paid. So take the cash price, 790. So when you less 790, 1.3, 1,300,000 minus 790, that gives me 510. So that will give me 510. So that's going to be your capital gains. Then your capital gains tax at 10% will give you 51,000. So that's it. That's it for that question. That's it for that question. All right, so bargains comprising 2 or more transactions. So, but before I go on here, I need to tell you that there are scenarios in which capital gains might be looked at. So let me say, sorry. Let me say capital gains tax scenario. So the first one is full and simple disposal. Second one, which we just did, is hire purchase and disposal. So in the case of hire purchase, we are looking at a situation whereby in the legal sense, the asset is not yours until you finish paying the installments. But the substance is that you own the asset because you are using it. And we say substance over form. And so you are selling off the asset. It is not your own. You have not finished paying it, but you take permission from the owner to dispose of it even before you finish paying off the asset. And so you treat the cost of acquisition separately. And the third one would be partial disposal. Now, partial disposal will be an asset you bought full, whole, and you start selling them in bits. For example, you bought full land and you start selling them parts by parts. Or you buy a house, maybe a twin duplex, and you now sell off one wing. It's partial disposal. That is where we are going next. Then the last scenario will be when rollover is required. So when rollover is required is this. You sold the assets and you quickly buy another asset of the same class. And that is a special way we treat it. So for each method, for each scenario, or each capital gains tax question, ask yourself, which scenario is playing out? In the case of this one we just solved, we saw hire purchase being played out. So we watch out for the scenarios. Now we look at part disposal. Where there is a partial disposal or part disposal, the cost of that part disposed and the undisposed part shall be apportioned. Normally, you bought the assets as one full block or one full thing, and now you are disposing one part. So the part you are disposing and the part you are not disposing shall be prorated. Now, the costs so that cost that you bought the assets, we will need to prorate that cost and share it into the part disposed and the part not disposed. Now, let me give you an example. Let's say this is a plot of land that you bought for 1 million naira, and you sold exactly half of it. We don't want to know how much you sold it, but what is the cost of the part you sold? You might say, okay, we are sharing the 50-50. So this will be 0.5 million, and this part will be 0.5 million. Now, assuming you sold 3/4 and not half, so you might say this might be 0.75 million. You are portioned the costs as 0.375, and this might be 0.25. So you are prorating the costs. So one thing you should know about partial disposal is you are going to prorate the costs using a formula. And the formula is what we wrote here. It is called A all over A plus B multiplied by C. Now, A is the amount you received from the part you disposed. So whatever that part you disposed, let's say this part you disposed, the amount you got when you sold this part is called your A. Now, a valuer will come and find the market value of this part you didn't sell. That market value of that part you didn't sell is called B. Then C is the cost of the whole assets when you bought them as one piece, which is the original cost of acquisition. All right, we're going to see a question on that, and we're going to look at it. But first, let's talk about connected persons. Who is a connected person? In tax practice, certain persons are treated as being so closely involved with each other that they are viewed as the same person, or that transactions between them shall be treated differently from those at arm's length. When we say arm's length, is you treat it as you don't know me from Adam. So if you are doing business, buying and selling, and you are selling something to someone whom you don't know from Adam, that amount you sold to the person is arm's length. Yes, you didn't cheat the person, but that is the commercial price. But when you now see somebody who is related to you, let's say your mother or your father came to buy something from you, you will not sell at that price. Your mother will say, or your father will say, all the money I've been giving you when you are small, have you forgotten it? Come on, give me the thing like that. You might even sell it for free. You might even give them at a very huge discount. It means the price you sold to them is not arm's length. So sometimes when you start telling someone that it's because of you, I'm giving you this price. This is not the normal price I sell. Yes, if it is not the normal price you sell, it is not arm's length. Because when you are selling to someone you don't know from Adam, you will sell at the normal price. So now, when somebody is connected, then transactions between these people, these connected persons, they are not treated as arm's length. Let me give you an example again. Okay, so Chimaroke is a director at FCA. And if FCA is selling a generator and Chimaroke is buying, so Chimaroke is a director, is connected to FCA. So the price that Chimaroke will buy it will be at a very, very low price. So it will not be connected. So how will you know a connected person? When there is somebody who is a director in 2 or more companies and they are doing businesses, these 2 companies are connected. When one person is in top management or can influence decision in 2 different places, those 2 places are connected. When a family person, a relative, is involved in this business, it's a connected person. And so you will see example of connected persons in capital gains tax. When a connected person is involved, the transaction is treated as artificial or fictitious for the purpose of determining the tax liability. This implies that the revenue can make whatever adjustment it considers to be necessary to counteract that reduction in tax liability. So it means that you went to give your father your property that you are putting for let, that you are realizing gains from for business. You now give your father at a very giveaway price. If you have not sold it to your father and you have sold it to a person you don't know from Adam, maybe you would have sold that asset for 1 million, which is the market price. But you now sold it for 200,000 naira to your father. The revenue people will say, okay, because you sold it to a connected person, you have reduced the gain you are going to get. You have reduced our tax liability. We are looking at it as artificial, as fictitious. We are going to treat your father's transaction with you as though it is, you don't know it from Adam. They will take it that you have sold it to your father at 1 million and you are going to pay the appropriate transfer price. So You see, when you are trying to do business with connected persons, you know, if you sell to them at a lower than market price, just be ready to bear the additional tax liability. All right, so you see, transactions between connected persons. When a connected persons acquire an asset, the person making the disposal is connected with him. The person acquiring the asset and the person making the disposal shall be treated as parties to a transaction made otherwise by them of a bargain at arm's length. The consideration shall be disregarded if less than the market value, and the consideration shall be deemed to be the market value. So you sold it for 200, market value is 1 million. They will disregard the 200 and they will assume that you have sold it at 1 million. Now we see connected persons here. An individual is connected with his or her spouse or relatives and their spouse. A trustee of a settlement is connected with the settlor. A partner is connected with the person with whom he is in partnership with, or with the spouse or relative of that person. A company is connected with another company if the same person controls both, or one is controlled by a person who has control of the other in conjunction with persons connected with him, or a person controls one company and persons connected with him controls the other, or the person is the same group of persons control both, or the companies are controlled by separate group which can be regarded as the same by interchanging connected persons. So you see, you need to know definitions of connected persons so that when you see it in the exam, because sometimes you'll be seeing questions where they will be telling you you're sold to a relative, you are sold to your father or to your friend. It will bring all scenarios. Just be looking out for connected persons. So that's another thing you should know about capital gains tax. Look out for connected persons and look at their transactions and judge it with the market value. Then we look at a company is connected with another person who either alone or with persons connected with him has control of it and all that. So we have seen connected person. Then look at consideration. Consideration for an asset acquired or disposed shall be deemed to be equal to the market value of the asset where any person acquires the assets. So otherwise than by way of bargain made at arm's length, wholly or partly for consideration. Let me just go straight to that point. So it means that if there's something is being sold, if something is being sold at 1 million naira in the market, right? And you manage to sell it for 1.2 million. Yes, that's fine. Your 1.2 million is still regarded as consideration because you've sold even above the market price. And that means more money for government. But if you sell it at 900,000, you have sold below market price. And that will be less money for the government. Government will disregard the 900,000 and will take it to be at market price. So whenever the consideration is more than market price, the consideration, what you paid for or what you sold for is taken as consideration. If it is less than market price, that will be disregarded and the market price will be deemed as a consideration. All right, so Okay, payable by installments. Talked about that. Going to places that is relevant. Talk about rollover. I want to discuss rollover next time. Or I want to discuss rollover last. I want to look at a partial disposal first, and let's treat a question on that. Talked about some of these things here, so just want to go to a question that has partial disposal before we go to rollover. How will you know a question deals with partial disposal? Let's see this and let's see if it is partial disposal. If it is, we are going to solve it. Best Manufacturing Limited is engaged in the production of building materials in Ogun State. Due to sudden power light surge at night, one or two of the two factories got burnt before firefighters arrived at the scene. Okay, then the factories were completely insured with Macon Insurance Company, PLC. The management decided to move the factory from Ota to Lagos. Concerted efforts were made to acquire land for the new factory in Ejibo and the factory in Ota that was not burnt with cost. Sorry, something is blocking my system. Concerted efforts were made to acquire land for the new factory in Ejibo and the factory in Ota that was not burnt, which cost 1.8 million 6 years earlier, was sold for 4.2 in March. The amount formed part of the cost of construction. No, this is not partial disposal. Somebody is asking a question. Somebody say, I can see your screen now. So there's no issue. You can see my screen. Looking for a question with partial disposal so that I can take that before I go to roll over. This question 4 happens to be okay. Let me see question 3. Okay, good. Question number 3. In April 24, Dr. Mensah acquired a house at a cost of 60 million. Other acquisition expenses. So this is incidental costs of acquisition were 100,000 for legal fees and 200,000 for valuation fee. On 30th November 2004, a duplex was constructed in excess space at a cost of 1.2 million. Okay, so This is, he acquired a house at 60 million and paid all of this. On November, a duplex was constructed in the excess space, 12 million. On June 1, 2005, the duplex was sold to Uncle Jimmy for 16 million. The actual market value was 20 million. Now, Uncle Jimmy is a connected person. And you see here, it was sold for 16 million. Now, what was built for 12 million was sold to Uncle Jimmy for 16 million. He will say, yes, but I make a gain, but the market value is 20 million. And the value of the remaining property was 68 million. 68 million. Okay. On January 6, Dr. Mensah sold the remaining property for 72 million after paying the following expenses. Now, compute the capital gains tax for the relevant assessment year. Well, this is still not partial disposal. Still not partial disposal, but we'll solve it. Let's say this is Dr. Mensah. Now let's look at (2025). This is the date he sold this, and 20 from disposal to Uncle Jimmy. Now, it was sold for Uncle Jimmy for 16 million, but we are going to disregard this 16 million because the actual market value here, 20 million. So we will say deemed, because Uncle Jimmy paid 16, we are taking it at 20 million. Why? This is a connected party transaction. Now, less costs of acquisition. How much was it acquired? It's acquired for 12 million. Okay. Now that's not the only part that is not the only cost of acquisition. You will say less incidental costs. Incidental costs. Now look at the incidental costs. 100,000, 200,000. So you come here, 100,000 plus 200,000, which will give you 300,000, right? But now, look something now. The whole building, okay, now look at the whole building, the whole land. The legal fee and valuation fee was 300,000, but the house was built here. Excess space was used for duplex. But this small excess space that was used for duplex, the legal fee also affected it. This other 200,000 and 100,000 affected it. And so We are going to share this 200, this 200 and 300. We are going to share the legal fee on this same part that was disposed. So what is happening here is that, look at here, the actual cost now, we will now use A all over A plus B multiplied by C. And you will say your A, how much did you sell it? 20 million. $20 million.
16 million.
Then still going to be A again, 20 million plus the remaining part that was not sold, 68 million. Multiplied by, how much are we looking at? 300,000. So what we'll now do, let's treat the denominator first. 20 plus 68 should give us 88 down here. So it feels like 20 divided by 88, now multiplied by 300,000. It feels like 68,182. So this is going to be 68,182. 68,182. That is going to be this incidental cost, which is 300,000 here, but we have prorated it and shared it 68,182 to the asset that was disposed. Okay, so that's the part that was disposed. We will now look at the capital gains now. The capital gains will now be 200 minus, okay, sorry, it's not 200, it's 20 million. What am I writing? 20 million. What again? $12 million. I want to write something else. Sorry. So this is 12 million. So this is going to be 20 million minus 12 million. That's going to give me 8 million minus 68,182. That will give me 7,931,000. 7,931,818. Okay. Now this is going to be your capital gains. Then your capital gains tax at 10% is going to give me 793,182. That's for that house, that part that was disposed. Second one in 2006, year of assessment, 2006, that will say cash proceed from disposal We disposed the remaining property for 72 million. 72 million. Yes, cost of acquisition. Acquisition cost. How much did it cost us for that house? That house was 60 million. So you are going to less 60 million. What other things are you going to less? You're going to less the incidental cost of acquisition. Now, we can do the same thing we did here by saying B. We can say B over A plus B multiplied by C. And where we will now say this is now 68 all over 20 plus 68 times 300. So this will be like 68 divided by 88 multiplied by 300,000. And you are getting 231,818. 231,818. Another way of doing it is you take 300,000 minus this 68,818. You will get this 231,818. So that's leagues and valuation. Then you come back here and read all these costs: improvement costs, agency fees, legal fees, advertising fees. I'll just call them incidental cost to disposal. The other one is incidental cost to acquisition. This is to disposal, 1,760,000. 1,760,000. So these are incidental costs of disposal. And we will less them now. Let's see what we are going to get. We have 72 million minus 60 million, the original cost of the assets. I'll give you 12 million minus 231,818 minus 1,760,000. That will give me 10,008,182. So that's it. Then my capital gains tax at 10% will give 1,000,881. So this is my capital gains tax. Two different periods. These are the taxes that you are going to be charged for these transactions. Now you see here that one thing you should know about partial disposal, you will see that they will mention that a part was disposed, and you will see the valuation of many parts not disposed. When you see that, you know that this is partial disposal. So we have looked at three scenarios here. We have looked at full disposal, simple full disposal. All we need to look at, how much did you buy the assets originally? How much are you selling them now? Did you make gain? If yes, how much gain? 10%. That's all. I buy my laptop, 1 million, and I'm selling it 1.2 million. 200,000 naira is the gain, and I charge 10%, 20,000. CGT. That's it. Then I'm looking at second scenario. I bought something as a whole, but I am paying it in installments. Shall whole higher purchase installments. Now, what makes it interesting is that I am selling these assets or disposing it, and I have not finished paying for the installments. What you now need to look out for the higher purchase part of it and remove it from the capital and remove it from the expected payments to your capital payments. And your capital payments will form the basis for computation of your capital purchase, which will be used to calculate your capital, your cost of acquisition. So purchase is also seen when they will tell you initial deposits and they will tell you installments. Then you are looking at another scenario where you buy something in whole, or you are selling them in parts. Now you are going to be valuing the other parts you didn't sell. And you're going to be using that part disposal formula to calculate your cost of acquisition or to calculate any assets that is any expense that covers the whole thing. But now when you are disposing it, you're only disposing part. Like we saw in the valuation fee and the lawyer's fee, it was for the whole land and property. But when a part is being sold, that part that was sold had enjoyed the valuation and the lawyer's fee. And so the lawyer's fee and that valuation had to be prorated using that formula to get how much to be charged to that part being disposed. Next class, which is part 2, we are going to be looking at something called rollover. We're going to be talking in details about rollover. Then we'll also revisit all these other aspects that we've discussed and probably look out for some past questions in which we will solve the theme of this capital gains tax question. So I will tell you that our capital gains tax will be at least 3 parts. We'll have part 1, part 2, and part 3. It's possible we might get to part 4. As I said before, this is a fundamental topic that gets tested every year, and all efforts to pass this topic will be welcome. So at a point in time, I will say we've come to the end of today's class. Part 2, we'll be discussing partial rollover. So come to a discussion of part 2. If you have any question to ask me at this time now, feel free to ask me this question. I'll be glad to answer. You may mute or unmute rather and ask your question so that we can take that. Okay, I can see no, neither can I see any message. Nobody's muting. That means no question. This is my cue to say that we've come to the end of today's class. Later, you will get the recording of this video so that you can watch for your better knowledge. Until then, from me to you, I say Bye-bye. We'll see you in next class.